Thank you, Kunsom. Sawadee krap to everybody. And we will now take you through the industry section. And we'll start with the first slide. If you can just go to the next slide. The next, yeah. So here you have China's performance shown to you and how they have done it in 2023. So despite the Western media saying that China did not perform well, if you look at iron ore imports, it was up by 6.6% to 1,108,000,000 metric tons. So it shows 1,181,000,000 metric tons, or 6.6% above 2022. If you look at China's coal imports, 475 million metric tons versus 293 million metric tons in 2022, or up by 62%. Similarly, if you look at steel production, it was just marginally above 0.5% above 2022 at 1,018,000,000 metric tons. If you look at the steel exports, it was at 91.1 million metric tons for the year versus 67.4 million metric tons for 2022, or up by 35.1%. And steel consumption was marginally down by 2.3%. So if you come to the next slide. Now, this shows you what's happened just in the month of December. So if you look at the month of December and look at coal imports at 47.3 million metric tons, it was up 53% year on year. And year to date at 474.5 million metric tons, it was up 62% year over year and 40% above the 5-year average. Similarly, if you look at iron ore imports at 101 million metric tons in December, up 11% year over year, and year to date at 1,181,000,000 metric tons, up 7% year on year and 4% above the 5-year average. Similarly, if you look at Chinese soybean imports at 9.8 million metric tons in December, it was down 7% year on year, but year to date at 101.8 million metric tons, it was up 12% year over year and 6% above the 5-year average. So you can see quite clearly China has done exceedingly well. If you come to the next slide. Now, this next slide shows you what's happening with the way people have been forecasting the Chinese economic recovery. So the Western media has forecasted a recovery based on what they saw happening in the Western world and forgot that China never really locked down the entire country at any moment of time during the COVID years. And when they went from lockdown in certain specific areas to no lockdowns at all, the change was not as dramatic as was there in the West. And therefore, the Western media had unrealistic expectations of the recovery rate in China, and that is why they were very disappointed. Growth was positive in the dry bulk import-exports, as I've shown you already in the previous slides, and consumer spending was doing well, but not so in industrial production and in real estate. Now, if you look at Country Garden, it's the next very large real estate company that is in trouble. If you look at dry bulk imports, it got support from China's policy of having energy security and food security. And then if you look at imports of iron ore, and other metals, it was strong despite weak real estate sector. And the reason for that was that electrical vehicle manufacturers, steel exports, shipyards, and infrastructure kept the momentum going for steel consumption in China. If you look at manufactured exports, they faced challenges from headwinds in the Western and developed world because their economies were not doing as well, and therefore they could not export their manufactured goods at the volumes that they were producing them. China has been behaving so far in a very fiscally responsible manner and is not overstimulating the economy. But having said that, over the last 1 month, I would say, China has started opening up the tap in terms of lowering the reserve requirement ratio of banks. And specifically, they just cut yesterday by a large portion, the largest cut that they've given since a long time, on the mortgage rates for property sector. And therefore, we think that they're trying to stimulate the real estate sector. If that also goes ahead, then you'll find that China will need to import more of iron ore and export less of steel. They'll import more of steel and iron. So we think that China's iron ore and steel demand will continue to grow. And as you can see here, in 2023, Chinese steel export numbers hit a 7-year high and was up by 35% over 2022. If you look at total steel production, add the imports, reduced export figures, then in 2023, Chinese steel consumption was apparently lower year over year by 2.3% compared to 2022. Now, if you look at steel demand for real estate, infrastructure was expected to decrease by 4.8% year over year, but the decline was partially offset by increased demand from the infrastructure sector, according to MPI research. Steel demand in other sectors grew by shipbuilding, as an example, by 15.4%, automotive by 12.4%, and energy by 5.6%, according to the China Metallurgical Industry Planning and Research Organization. Despite the decline in consumption, Chinese iron ore imports showed a 6.6% increase over 2022. And if you look at Reuters, they analyzed the growth, and they said that it was driven by the lifting of the government steel output cap policy and lower steel scrap availability for producing steel, therefore the requirement for more iron ore. Financial Times also cited some possible explanations for the growth, such as an infrastructure stimulus plan driving iron ore restocking and iron ore price appearing cheaper due to stronger yuan. So if you come to the next slide. This slide is of great interest. If you look at the total numbers on the top, just look at the lowest row. You see total consumption of steel between 2018 and 2022, which is a 5-year average, was 953 million metric tons of steel per annum. If you look at 2023, it was up to 971, or up by 2%. So you can see which sectors really made a difference. Now, if you look at real estate, it was down by 11%. But if you look at infrastructure, up by 15%. Look at machinery, up by 15%. Look at auto sector, up by 1%. Exports, up by 45%. And others was down by 7%. So you can see totally China consumed more steel in 2023 than the last 5-year average numbers. And we've given you the breakdown of the thing in more detail in the lower portion of the slide. If you come to the next slide. Now look at India's performance. Now, India again has outperformed significantly. So if you look at iron ore exports as an example, it was up by 169%. In the first 11 months, it was at 37.6 million metric tons versus 14 million metric tons in 2022. If you look at India's wheat exports, of course, they were down by a lot, by 98%. That is because wheat exports have been banned in India because they have a local election coming up in a few months' time, and they want food security and food prices to be as low as practical. If you look at India's rice exports, similarly, it was hurt by a ban on certain grades of rice from being exported, and therefore it is down by 17.5%. And again, it's because of the elections that are going on in India. In terms of coal imports, it was up by 1.6% and was at 213 million metric tons versus 210 million metric tons in the first 11 months of 2022. India's steel production at in the 11 month of 2023 was 123 million metric tons versus 113 million metric tons in the 11 months in 2022, and was up by a staggering 8.3%. Average steel, if you look at steel imports, it was up by 18.7%. Steel exports was down by 23.1%. And if you look at steel consumption, it was up by 10.9%. So you can come to the next slide. So again, you can see that India, the second largest growing economy in the world, has also done very well. If you then look at the total demand figures and look at the fourth row from the bottom, you can see that in 2023, the estimated figure is 5.08%. Against that, if you look at the last row and the column for 2023, you can see that the dry bulk sector grew by 2.9%. And if you look at 2024's forecast, it's showing that growth in demand will be 1.5% versus that there will be a growth in supply of 2.3%. This is for the overall dry bulk demand in billion ton miles. If you come to the next slide and look at the minor bulk demand, which is where pressure shipping spends most of its time. If you look at that demand, it grew by 4.07% in 2023 versus a fleet growth in the geared sector of 3.2%. If you come to 2024, the forecast for demand is to grow by 3.62% versus a fleet growth of 3.2%. So if you look at just minor bulks, which is the cargoes that we mainly carry, it looks really good. You come to the next slide. Now, what I'm going to show you here is that Clarksons, with all their research capabilities, are not able to predict the right numbers for trade growth, and they get a better feel for fleet growth. So if you look at the left-hand side, topmost quadrant of this slide, you can see that how overall demand is shown in the lighter column and minor bulk demand is shown in the darker column. So you can see that in January 2023, Clarksons were forecasting a total growth of only 1.59% for 2023. Against that, they were forecasting for minor bulk a growth of just 0.47%. And by the December edition, they had raised the overall growth rate to 5.08% and the growth rate just for minor bulk at 4.07. Now, if you look at 2024, that is the right-hand side topmost column, topmost part of the graph, you can see that in the beginning, they were forecasting in January 2023, they were forecasting for 2024 overall growth of 2.02% and minor bulk to grow by 2.82%. And by the end of 2023, they had changed that figures to 1.5% for overall growth, but the minor bulk growth would go up to 3.62%. Similarly, if you look at the fleet growth profile and how it has changed, you can see that overall for the total dry bulk fleet growth it began at 2.4% and ended up at 2.9%. And for just the geared sector, it began at 1.3% and then ended up at 3.2%. Similarly, if you look at 2024, overall growth in the beginning of the year in 2023 for 2024 showed a forecast of 0.3% overall growth and 0.6% growth for minor bulks. And by the end of last year, they were forecasting for this year 2.3% overall growth and 3.2% growth for the geared sector. If you can go to the next slide. Now, here what we've tried to show you is that how ships in the different sectors are affected by congestion. So if you look at this slide and look at the last column and look at the handy-size sector, it says that though deliveries are expected at 4.4% and scrapping is expected at 1%, so net fleet growth is at, say, 3.4%, it would be equivalent to 5.8% if congestion is the same as 2023. Now, if congestion is the same, or rather, if congestion drops from the pre-COVID congestion levels, then the growth in demand, growth in supply would be 7.1% for handy size. So these are the numbers that you should really understand, because congestion plays a role in reducing the total fleet size. If you look at Supras and Ultras, if we get the same congestion levels as 2023, then Supras Ultras will grow by 4.8%. If you look at Panamaxes, they'll grow by 5.4%, and if you look at Capesizes, they'll grow by 1%. If you can come to the next slide. Now, this slide shows you how much time each sector spends on different types of cargoes. So if you look at the Capesize sector, they spend 74% of their time carrying iron ore, 19% of their time carrying coal, and 7% of the time they carry one single minor bulk cargo known as bauxite, which is from Guinea in West Africa, where the mines are owned by the Chinese, the railroads are owned by the Chinese, leading to the port. The port is owned by the Chinese, and the ships that take this trade to China mainly are owned by Chinese companies, either in mainland China itself or based out of Singapore. So you can see that they spend their time mainly in major bulk cargo, which is iron ore and coal, and 7% of the time on carrying bauxite. If you then come to Panamax, you'll see that they spend 8% of the time on iron ore, 52% of the time on coal, and then 25% of the time on grains, and 15% of the time on minor bulk. But if you look at the Supra and handy size and just look at the minor bulk exposure, we spend 54% of our time in Supras carrying minor bulk, and in handy size, we spend 66% of our time carrying minor bulk cargo. So we are more affected by the minor bulk cargoes than with the major bulk cargoes. If you then come to the next slide. Now, here what we're trying to show you is the net supply growth. I think you've gone back. We have to go forward. Yeah. So here what we're trying to show you is what has been the total growth of tonnage last year. So at the start of January 2024, the top half of the slide shows you where we are in terms of the various sectors and what is the total deadweight tons in each of the sectors, what is the average size per ship in each of these sectors. So you can see for the handy size, the total deadweight is 118 million metric tons, and the average size per ship is 26,627, and the average age in the handy size sector is 14 years of age. If you come to Supra and Ultra, the average age is 12 years old, the total size is 234 million deadweight tons, and the average size per ship is 56,000 deadweight tons. If you come to Panamax, The average age is almost 12 years again. The total deadweight is 219 million metric tons, and the average size is 80,000 deadweight tons. And then if you come to Cape sizes, you can see that the average age is the youngest. It is just at 11 years of age. There are 425 million metric tons, and the average deadweight per ship is 182,000 deadweight tons. If you look at the last column on the lower part of the slide, you can see how we've added deadweight tons net position during 2023. So for the handysize, we've added 3 million metric tons of deadweight tons in the handysize sector. In the Supra, we've added 8.6 million deadweight tons. In the Panamax sector, we've added 8.3 million deadweight tons. And in the Cape sizes, we've added almost 11 million deadweight tons. If you come to the next slide. Now, this is our forecast on the right-hand side of what we expect to happen during 2024. So we are projecting that in 2024, there'll be a slippage of about 5%, and we expect that there'll be 10 million deadweight tons of scrapping. Based on that, if you look on the line on top, you can see that there'll be a total net change in fleet size in the dry bulk sector at 2.45%. If we come to the next slide. Now, this shows you what is the forward order book. And if you look at the number which has been highlighted in the box, you can see that the total order book is at 83 million deadweight tons, or 8.33% of the existing ships at the start of this year. If you come to the next slide. And here you see that the total ships that are over 20 years of age is 8.48% of the existing fleet. And against that, we have an order book which is all the way up to end of 2026 at 8.33%. Therefore, it seems that the order book is just about in replacement of the 20-year-old fleet. We come to the next slide. Now, this is an interesting slide. We are trying to show you the differences in different time periods. And if you look at the big bull run between 2003 and 2009, and if you look at the fifth row from the top, you can see that the annual average demand in billion ton miles grew by 5.4% per annum during that period of time. In the 2010 to 2020 period, that's 11 years, it grew by 4.3% per annum. And if you look at 2021, 2022, those 2 years, the average growth rate was just 0.95%, less than 1%. And if you look at 2023, as I said, Clarksons have now revised that up to 5.08%. And for 2024, they are forecasting a 1.5% growth in demand. If you then look at the next row below that, it shows you what was the average speed of ships in each of those periods of time. And they were running at 13.5 knots per hour in the 2003 to 2009 period, which dropped then to 11.5 knots per hour during the 2010-2020 period, dropped further to 11.3 knots per hour in the 2021-2022 period, and in 2023 it dropped down to 11 knots, and now in the first 1 month of 2024, we can see that that figure has further dropped to 10.9 knots per hour. If you go then to the last row, it shows you what is the annual average net supply growth. And you can see that in the 2003 to 2009 period, it averaged 6.8% per annum. In the 2010 to 2020 period, it was almost similar at 6.4% per annum. But in 2021, 2022, it dropped to 3.3%. In 2023, it dropped further to 2.9%. And in 2024, Clarksons are estimating at 2.3%. And remember, we estimated the same figure at 2.45%. So we come to the next slide. These are the average speeds. So I think we've already covered that. So we can go to the next slide. This shows you the congestion numbers. So you can see clearly in 2021 and 2022, despite the fact that demand only grew by 1%, we did really well during those 2 years because congestion was at its peak at almost 33% of ships. So that was the main difference. Now, if you look at the 5-year and 7-year average, that the 5-year average is between 2016 and 2020, that is before COVID era. If you look at that period of time, the congestion average stood at 29.9%. And if you look at the 7-year period, including the 2 years of COVID, then that goes up to 30.7%. And compared to that, the average in 2023 had dropped to 30.5%. So this tries to explain to you how congestion can make a difference. If you can go to the next slide. This slide tries to compare the average of the BDI in each year, starting in 2023 and goes back all the way to 2020. So if you look at just the BDI, then 2023 was 29% lower than the average in 2022. It was 53% lower than the average in 2021. And it was 29% above the average in 2020. Remember, 2020 was the first year when COVID hit the world, and therefore demand was destroyed in a big way during that year. Now, if you look at the last two columns, the second last column shows you the amount of ships that were added during the year as new orders. In 2023, compared to 2022, it was up by 12%. Compared to 2021, it was down by 23%. And compared to the very anemic year of the COVID start of 2020, it was up by 64%. So really, 3 reasons why ship owners have not ordered too many ships. One is that all the other sectors which really boomed before the dry bulk sector, they all crowded out and took up all the orders that were there available in the shipyards for their ships. And therefore, the earliest we can buy slots for is now in 2027. Shipyard capacity is still 40% below the peak. There are 119 active large yards in 2022 versus 320 in 2009. And the main problem is that there is a fuel transition also taking place, and therefore people don't know what type of ship to order. You can go to the next slide. Yeah, so coming to a summary of what the industry takeaways are, IMF is increasing the world GDP growth rates for 2023 to 3.1, as well as to 2024 to again 3.1%. China's GDP is forecast to grow for last year at 5.2%, but the IMF's new forecast for last year's growth for China is at 5.4%. Demand growth of 5.08% in 2023, as forecast by Clarksons, will be driven mainly by China's economic recovery. The dry bulk fleet has grown by 2.9% in 2023 and forecast is to grow by 2.3% in 2024, but net supply will be reduced by 1.5% to 2% in 2024-2025 due to lower speeds via compliance with EEXI and CII regulations. China's fixed asset investments for last year was up by 3% and consumer spending had rebounded. So therefore, China fared well. Forward order book to fleet ratio at 8.33% as of 1st January 2024 is lower than the existing 20-year-old fleet at 8.48%. Therefore, it appears that it will just about replace the older fleet. Congestion at the Panama Canal at South and North American grain ports have pushed rates up. Steel consumption in China till end of 2023 is marginally negative year over year, but supported by shipyards, EV car makers, infrastructure spending, and steel exports. Supply-demand balance continues to improve. If you can just go to the next slide. Yeah, so what has been our strategy? Our strategy has been to try and reduce the average age of our ships. As you can see that the average age has now crept up to 12 years. And as you must have noticed also, we have sold one of our oldest ships, which was 22 years of age. And so this will make a difference in the age profile that we have. The average deadweight is at 43,621, and that will go up a little bit because the ship that we sold is only 29,000 deadweight tons. If you can go to the next slide. This slide shows you the market segmentation. And if you look at our handy size ships, which is averaging 31,000 deadweight tons compared to the index ship at 38,000 deadweight tons, we were 1.34% below the index level. However, the index level should be discounted by 25% to make it apples and apples comparison between our fleet and the index ship. So we have fared quite well, despite the fact that our deadweight is so much smaller than the index ship. If you look at the Supramax index, it was averaging $11,240 per day per ship. Against that, our fleet had 11,682, or it was up by 4% above the index level. And of course, our aim is to try to beat the index. If you can go to the next slide. This slide shows you the forward 4-year book. Now, if you look at this slide, what do you see? You see in 2023 that 52% of our revenue was pre-booked, and it was pre-booked at an average price of $13,756 per day per ship. And if you, by $13,870 per day per ship. If you come to the year 2024, that figure drops to 40%. Now, this is all ships that have already been pre-booked. So we have 40% of the revenue for 2024 pre-booked at a price of $13,908. So that works out to $81 million. Last year was $99 million was from pre-booked revenue. 2024 will be $81 million. Similarly, 2025 will be $30 million. And similarly, 2026 will be $27 million. And 2027 will be $25 million. That is a total of $261.24 million was pre-booked revenues over the 5-year period that we're looking at. That is 2023 to 2027. If we can come to the next slide. So that comes to financials, and now Gautam will take you through the rest of the slides.
Thank you, Khalid. So some highlights for the year 2023. For the year, we had a net profit of 709 million baht, or baht 0.46 per share. Our EBITDA came in at 2.222 billion. For the fourth quarter, our net profit was 246 million baht, or 0.16 baht per share. This was clearly the strongest quarter that we had in 2023. Our EBITDA came in at 725 million. In terms of dividends, so we declared 3 interim dividends last year, and in fact a fourth interim dividend at a recently held board meeting for this is for the fourth quarter of 2023. So in terms of long-term charter contracts, as we previously mentioned, so we've got 5 ships under long-term charter contracts, fixed rates, and another 18 ships at long-term charter contracts at variable rates. So in terms of financing, it was a very active year. In April last year, we completed the drawdown of a $9 million loan from EO Bank. This is a Japanese bank, and we used the proceeds to prepay a $4 million loan from Sinopac, which is a Taiwanese bank. We also upsized a loan that we had from Bangkok Bank with an additional amount of 31.8 million. So the total amount has been increased to 48.9 million US dollars. And we already completed a partial drawdown of this facility, 33 million. We entered into a new credit facility with the Export-Import Bank of Thailand. This is in the amount of $26.25 million. In October, we signed a $105 million facility with International Finance Corporation, Exim Bank of Thailand, and Credit Agricole to finance the acquisition of up to 6 dry bulk vessels. And we have an availability period of 24 months for this facility. We also, in November, entered into a credit facility in the amount of $37.5 million with Credit Agricole. We used the proceeds to prepay an existing facility of 26 million that we had with Credit Agricole. But we also actually released 2 ships that we had as part of the security package. The initial loan that we had, Credit Agricole, had 6 ships in the security package, and that reduced to 4 ships. And then finally, we entered into a new facility with Sinopac. This is in the amount of 18 million. And the availability period of that loan is also 12 months. So some highlights for key figures for 2023 compared to 2022. So the total revenues in 2023 were 149 million, down from 260 million in 2022. Our net profit as a result was down from 138.6 million in 2022 to 20.4 million in 2023. Earnings per share also reduced from 3.11 to 0.46. Return on equity reduced from 30.6 to 3.99. The net debt to equity ratio continued to reduce somewhat. So that is now 0.31 compared to 0.34 at the end of 2022. And at the end of the year, we had 38 ships, which is the same as we had at the end of 2022. We're looking at quarterly figures now. So in Q4, as I said, Q4 was the strongest quarter we had. So our total revenues in Q4 came in at 40.6 million compared to 35 million in Q3. Our net profit was 7 million compared to 2.8 million in Q3. Earnings per share 0.16 compared to 0.06. Return on equity was superior. It came in at 3.99% compared to 2.77%. So this over here, we show you graphically how rates have evolved. This is the average TC rate per day per ship for our fleet. You'll see, and again, so Q4 was our best quarter in 2023. Similarly, we had the best EBITDA in Q4 as well, which was at 21 million. And these are the dividends, and this is our cash balance. Our cash balance at the end of the year was 68 million. This is our statement of financial position. So you'll see, for instance, the vessels and equipment, which is the bulk of the assets that reduced from 638 million at the end of 2022 to 609 million. This is primarily because of depreciation. Cash was up from 31 million to 68 million. Shareholders' equity was quite flat, 476, 475. And loans were slightly up, but since then we expect this number to vary a bit, depending on, because we are refinancing some loans, prepaying some loans, drawing some new facilities. So there'll be some variability there. Okay, so this is the cash movement for the full year. We began the year at 31 million of cash. We generated 64 million from operations. We spent 12 million of cash towards capex, which is primarily dry dock special survey expenses. Interest payments were 12 million. We had loan drawdowns of 88 million, loan prepayments of 68 million, dividend payments of 18 million. But we had a gain on the unwind of an interest rate swap of about 2 million, and we ended the year with 68 million. These are the figures for the cash movement for Q4 2023. So there's we started the quarter of Q4 with 33 million of cash, and cash from operations was 19 million. So the big movements over here are the loan drawdown. We drew down a loan in December from the Exim Bank of Thailand, so that caused that to go up. And then we also Crédit Agricole, and we prepaid certain loans primarily with Crédit Agricole, and we ended the quarter with 68 million. This is a breakdown of our operating expenses per ship per day for 2022 as well as 2023. So if you look at the different items, you'll see that crew costs remain quite stable, lube oils as well. Insurance, there was a bit of hardening in the market, so we started to see we saw a bit of an increase, but yeah, the good news is that so between 2020 and 2023 there were quite sharp increases in insurance rates, but those increases have started to decline and to some extent flatten out, and that repairs and maintenance has remained quite stable. Storage and spares, dry dock special survey expenses, so these were somewhat elevated, and part of the reason for that, well, twofold. Number one, our fleet is getting older, so it's a bit more expensive to operate the fleet, but also we were not the inventory levels of things like spares on board our ships were somewhat low during the COVID period, and we are replenishing those that inventory, so there's an elevated expense because of that. And so we ended the year with OPEX of 5,000, average OPEX of 5,200. These are the quarterly figures. So it's more or less a similar story here. So here we show you our operating expenses compared to the industry average. So from 2016 to 2021, the industry data that we have has been compiled by BDO, but then they stopped publishing this data. And so we started comparing our operating expenses to figures that are published and by Braemar. And you'll see that we continue to have operating expenses that are quite below the industry average. Every $100 in savings on operating expenses translates to about $1 million on the bottom line for each year. Okay, over here we show you peer analysis. So the Supramax, Ultramax sector listed companies in our space, Supramax, Ultramax sector. So you'll see that the operating expenses and G&A expenses that we have are much lower than most of our industry peers. Also, if you look at our EBITDA per ship, it's also very, very good compared to most of our peers. This is the debt maturity profile, and so we've been doing a lot of refinancing, so I mentioned, so therefore the debt maturity is getting pushed out. It's the net debt to equity ratio, which at the end of 2023 was 0.3, and the net debt was 146 million. This is our average OPEX and TC rates. This is from the year 2000 until 2023. So you'll see that, okay, so first of all, the average size of ships in our fleet has increased quite substantially. It used to be about 22,000, and then we embarked on this program to upsize our fleet. And the average size of ships in our fleet is now about 43,621. This over here shows you the average TC rates per ship per day over time. So from 2003 until 2009 is when we had these sort of super cycle years when China joined WTO. But then you saw that the order book went up to about almost 80% in 2009, and all the ships got delivered from 2008, 9 until 2016, and that led to a gradual drop in rates. Fortunately, the supply side pressures have eased, and so you started to see more of a balance in the market, demand-supply balance in the market. And so that you're starting to see, of course, rates are volatile, but they're generally higher because of a healthier balance between demand and supply. This over here shows you the operating expenses over time, which as you can see is fairly stable. Of course, it was impacted by inflation in the last few years, but otherwise fairly stable. These are our dividends over time. Our policy is to pay not less than 25% of net profit as dividend, and we've continued that. In fact, so 2023, the dividend yield is about 54%. So the financial highlights, I'm not going to go through the numbers, but just very quickly, if you were an investor in our IPO in 1993, and if you reinvested all your dividends back into our stock, you would have earned a 15.78% IRR. And here's a comparison of our returns with several listed dry bulk companies. Okay, I'm going to leave the rest of the slides for people to look at on our website, because I'm mindful that we have only 3 minutes left for questions. So I think we can open this up for questions, perhaps.
Okay, so we have quite a few questions which have already come in from the floor. So I'll start with the first one. You've sold one ship. Will you plan to buy new ships this year? And what green ships are you looking at? Yes, we sold one ship. The idea is to keep selling the older ships and to keep replacing them with younger, larger, and more economical ships so that our carbon footprint keeps coming down. So green ships are still not yet being developed for the dry bulk space in the geared sector. Once that is done, then we'll look at that. The next question is, what is the percentage of current PSL's minor bulk fleet to PSL's total fleet? Our entire fleet is in the minor bulk area. The third question is, how much frequency in a year that the ships will be assigned for dry bulk or minor bulk tasks. As I said, we do carry some major bulk cargoes, which is grain and coal, but other than that, we are mainly spending our time carrying minor bulks. The next question is, how many weeks will the ship spend for the dry dock? Most of our ships that dry dock spend a total period of time of between 12 days and 18 days, not more than that. Question 5 is, only empty ships will be assigned for the dry dock, or any ships that are due to the inspection schedule? No, it has to be only empty. You cannot dry dock a ship which already has cargo on board. And question 6, how much margin does the revenue from variation rates or from variable rates compare to the revenue from fixed TC rates? So it depends on how the index behaves. If the index goes up sharply and you have your ships on a variable index linked rate, then of course your revenue goes up immediately. And if you have a fixed price contract, let's say that at the beginning of the year we fix our entire fleet at $15,000 a day for the whole year. And if the index level goes up to $25,000 a day, then our ships will be $10,000 below the index. Similarly, if you fix your ships on index link and the index comes down, then if you are fixed at fixed level at 15,000, index comes down to 10,000, then the fixed price contract would be better off by $5,000. It's just a question of how much does the index vary compared to what you can get on the fixed rate level. The 7th question is, does the single hull vessel require higher maintenance cost than the double hull? There's not much difference between these two for the dry bulk sector. The 8th question is, forward order book in 2024 is at 8.33, while the 20-year-old fleet is slightly higher. Does this imply the upcoming slight supply shortage in 2024 will the new build ships, which are aimed to be deployed in 2024, offset such shortage? So as you can see from the slides that we have already presented to you, the total change in the ships as expected by Clarksons is 2.3%, 2.45% as compared to is what we think. And if you compare that with just the minor bulk growth is at 3.2%. Therefore, we will do better when we are in the minor bulk sector. The 9th question is, due to rising container freight index, will more cargo flow from containers into dry bulk? Yes, it's already happening, but there is no way of knowing the exact numbers. The 10th question is that what is the rate of recurring customers with 4-year forward contract? These are only 5 ships which were fixed at 15 years from the time they were built. So those 15 years will start to expire between 2027 and 2029. So till then, we will have these 5 ships on a long-term fixed price contract. So that ends the questions that have come in through the chat box. So if there are any other questions from the floor, you're more than welcome to unmute your mic and ask those questions from us.
ค่ะเผอิญเวลาของ PSL ของการ present ในท่านนี้ได้หมดลงแล้วค่ะจบลงถ้าไงคำถามคำตอบที่มีในวันนี้เดี๋ยวเราจะขึ้นโพสต์ที่เว็บไซต์ของบริษัทให้นะคะค่ะขอบคุณทุกท่าน Thank you very much for everyone to join us ขอบคุณค่ะ
ขอบคุณครับสวัสดีครับ
สวัสดีค่ะ